This has been a tough moment for footwear and athletic apparel, with both Nike and Lululemon feeling impaired. Nike hasn't been a good stock for over 2 years now, and Lulu's now down almost 35% from its all-time highs last December. They're not just weighed down by the usual worries about the tapped-out consumer. They're also struggling with endless competition. Everybody in the space is going against Nike. Well, Lulu's up against a host of smaller, fast-growing athleisure brands like Gap's Athleta or Levi's Beyond Yoga, among others. They have put more money behind Beyond Yoga. As a result, this business has a growth problem. Nike's looking at 1 or 2% revenue growth this year. Lulu only got for 11 to 12% growth when they gave you their full-year forecast in March. Wall Street wanted 14%. Last year was 19%. I remember it was even much higher than that. So where can you find growth in this group? Tonight, I want to highlight 2 growth stocks in the athletic footwear and apparel space that are still working that I don't talk to you enough about on holding. And, you know, I like them very much. They're the parent of the red hot, I mean like smoking, On footwear and apparel brand. And then Deckers Outdoor, which we like for its Hoka running shoe, although it's also got Uggs and Tevas. When On reported this spectacular quarter earlier this week, it showed you that some brands are just working a lot better than others. But first, let me set the scene. On rallied like crazy early last year, climbing to the mid-30s before pulling back with the rest of the growth cohort last summer and into the fall. It dropped to the mid-20s back then. When we remember, we checked in with management. The darn thing was still stuck at around $25, even though On Holdings had just put out a bullish analyst day where they rolled out some ambitious long-term financial targets. They said they were going to double their sales from 2023 to 2026, for heaven's sake. How's that for growth? Since then, the stock's been running with only a couple of interruptions along the way. The last couple of times they reported in November and March, the stock sold off in response, even though I thought they did well, and eventually the market seemed to come around because the stock bounced right back both times, thank heavens, because I pushed it both times. But with the broader growth stock sell-off in March and April, On Holdings came into earnings this week on a weak note, having fallen from $36 in early April all the way down to $30 and change on Monday night's close before they reported the next morning. So the market was caught off guard when On turned in a gem of a quarter. Keep in mind, this is a Swiss company, so their numbers are all in Swiss francs. Still, they delivered 21% revenue growth, and it would have been 29% on a constant currency basis. Management said their excellent growth was fueled by strong demand, including major momentum for the direct-to-consumer channel, which includes both their online store and a growing footprint of retail locations. Remember that one we went to in Williamsburg? It was really great. We were there last summer. Direct-to-consumer sales are up 39% year-over-year, or 49% on a constant currency basis. That is gigantic, especially because direct-to-consumer is more profitable, given that you cut out the middleman. Speaking of profitability, On's gross margin came in at 59.7%, up from 58.3% a year ago, on the doorstep of the medium-term target, which is 60%. Meanwhile, earnings before interest, taxes, depreciation, and amortization were up 27% year-over-year. Net income more than doubling versus last year. On Holdings made 33 Swiss cents. Get this, Wall Street was looking for 14. Wow. The strength here is incredibly broad-based, with better-than-expected sales in the Americas and Asia-Pacific, the 2 key growth regions, up 52% and 76% respectively. Everything seems to be working for these guys now, from the company's sponsored athletes like Helen Obiri, who just won the Boston Marathon for the second consecutive year, covered head to toe in On gear, to its new product launches, which are performing well, to its channel strategy, where those direct-to-consumer numbers were incredible, to my closet, where my wife has tons of these. Now, On Holding only maintained its full-year forecast of at least 30% net sales growth and a gross margin around 60%, while talking about, quote, a commitment to ongoing profitability increases. On the other hand, management also said they're, quote, remaining prudent in light of the dynamic macroeconomic and consumer environment, end quote. Hey, look, that's why they didn't raise their forecast after a strong first quarter result. That was the only reason I'm still on board. But with the stock coming into the quarter cold, the strong results were enough to send the stock up 18% on Tuesday. Added to those gains in the last 2 days, with this breakout, On's reached its highest level since the first few days of 2022. And you know what? I don't think it's anywhere done going up. By the way, there's big short position. Those guys are going to be wrong. Well, they're kind of wrong already. If you're looking for a company with similar growth prospects in the athletic footwear / apparel space, right now I can only think of, and this is one I haven't pushed enough, Deckers Outdoor. For those of you who don't keep track, Deckers is a parent of multiple brands, Uggs, Tevas. Right now I want to talk about the company's principal growth engine, and that's the Hoka brand, H-O-K-A, which is their running shoe brand, like soon to be becoming their top-selling brand, too. People don't use it just to run, and I know that. Now, Deckers is yet to report. We're going to get the results a week from now. Consider that a disclaimer, because you never know how any individual quarter is going to go. I certainly don't want you to buy this one ahead of the quarter. That's not our game here on Mad Money. But I do expect a strong set of numbers from Deckers thanks to Hoka. This running shoe brand has grown from $223 million in sales back in 2019 fiscal year to, get this, a projected $1.78 billion in sales for the fiscal 2024. That's fantastic growth. That quarter ended in March. In other words, Hoka's had a compound annual growth rate of 51.4% over the past 5 years. No wonder parent company Deckers has seen its stock surge 513% over the same period. So that's how real money's made. We'll see what Deckers has to say about Hoka next week. But if you look over the last 3 quarters, the numbers have been great. Just like On Holdings, their direct-to-consumer business is growing like crazy. They're also expanding aggressively overseas with a lot of success in Europe and China. You don't hear many other footwear apparel plays talk about those 2 regions as the source of strength. And by the way, have some real staying power. So what's the catch with these 2 growth footwear stocks? All right, now this is where it gets really important. They're expensive. They're really expensive. On Holdings sells for over 33 times next year's earnings estimates. Deckers sells for 25 times next year's numbers. But you know what? You have to pay up for outsized growth, and these companies can deliver it. More important, this market values growth again, which means these stocks can work. Let me give you the bottom line here. Even when the footwear and athletic apparel space is a nightmare for most of the industry, you can still find great brands that are winning, like the ones that belong to On Holding and Deckers Outdoor. And you know what? I bet they keep winning. Mad Money is back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.